We talked about FCNR, and there are all sorts of media reports that there could be significant flows in FCNR of 50 to 80 billion, or some estimates even say 100 billion. So we thought it would be useful to really see why market participants are talking about these kind of flows, especially when US interest rates, like we saw during one of the previous slide at 4.5. Why will somebody invest in India at a 6% or a 7% interest rate? So the real catch in FCNR is not really the interest rate, which is a 6 or 7, but because RBI is bearing the full cost of the swap for the period of 3 and 5 years, a bank can offer a leveraged deposit to a non-resident Indian, where a non-resident Indian, for example, invests $100,000, they get a 10x or a 15x leverage, which on top of that deposit, which is let's say 1 million or a 1.5 million. So the total pool of investment for that non-resident Indian is not 100,000, but it's actually 1.1 million or 1.6 million in this case. And the typical cost of borrowing for that, because it's loan against deposit, and there's a RBI risk involved, so the risk is quite low. Uh, the borrowing cost becomes very nominal, which is a 5%. But if you look at, you're getting a 1% differential. So basically, 1% differential at a 10x leverage, straight away, you are able to make a IRR of 16%. If you take a leverage to 15x, you can make a IRR of 20%, and that's in dollar terms. So a 3 to 5 year IRR of 15 to 20% is quite attractive for investors. Of course, for non-resident Indians, there is a certain home bias as well. We every year we see remittances of more than $100 billion from non-resident Indians. So we do expect that this scheme will be taken up quite well by non-resident Indians, and we do expect flows about 40 to 50 billion dollars from non-residents. The second scheme, which is also expected to get about 10 to 15 billion dollars, is the RBI ECB scheme, where RBI will bear half of the cost of the 3 year forward by state-owned entities. So it's only open to state-owned entities. It's not open to the private sector. So typically, if you look at the current forward rates, the withholding tax, etc., typically the all-in cost on a fully hedged basis for a state-owned entity, which is a AAA, is about 8.5%. And the 3 year bond yields are close to 7 quarter 730. So of course it makes sense for those state-owned entities to borrow from domestic market rather than go towards the offshore market. But with the swap being in place, so if you look at this, the second line in my right hand side table, so instead of 3%, the state-owned entity only has to pay 1.5%, because the 1.5% will be borne by RBI. So straight away, that cost, which was 8.5%, moves to 7. And now it becomes cheaper for the state-owned entity to borrow from offshore rather than onshore. And hence we expect 10 to 15 billion dollars to come from that window as well. Why not more? Because of course the capital towards Indian credit is limited, the risk appetite is limited. Investors who look at India look at sovereign Indian risk as well, corporate India risk as well. But typically it's largely EM focused investors. There is only a limited pool of capital which is available towards India-focused corporate bonds. So we do expect beyond, it will be difficult to get more than 10, $15 billion in this window. But even if we get, I mean, that will be quite welcome again for the domestic bond market as well, because this has an implication on all our portfolios. Because as these entities will go and borrow from abroad, they will borrow less from domestic market. So as the supply of corporate bond comes down in the domestic market, that is quite good for corporate bonds up to 3 5 years. Because when these entities go and borrow this 3 to 5 year segment abroad, basically they will be supplying less bonds to the domestic market. And that can lead to some spread compression and some rally in the corporate bond in India. Moving on to the next slide. So apart from improving corporate bond yields, this measure is also expected to boost liquidity. So one, these measures will help diversify corporate bond supply from onshore to offshore, because all this money will flow into India, which could be 50 to 60 billion dollars. In simple terms, taking a 95 USD INR rate, you are looking at about 5 lakh crores of liquidity straight away coming into India. So your system liquidity, which is close to about 3 lakh crores right now, can move towards 8.5 lakh crores. And of course, as the government spending happens, currency leakage happens, that liquidity will go down. But this 5 lakh crores of liquidity, which can come in the next 3 months, was not anticipated in the beginning of the year. So as that liquidity comes in, you will also see, and all this liquidity will come into the banking system. So basically, banks will have less incentive to issue high rate CDs as well. So if you look at the money market curve as well, so I talked about the corporate bond curve in the previous slide. If you look at the money market curve as well, that will also see tremendous improvement once these flows start to trickle. So you will see the benefit across from 1 year part of the curve to all the way to 5 year part of the curve because of heavy liquidity from FCNR as well as the state-owned entities doing offshore bond.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.